Welcome to Markets Insight. Today, we'll be taking a swift look at two of the biggest issues facing financial markets, the looming US fiscal cliff and the new, or not so new, political order in China. With me are Sushil Wadhwani of Wadhwani Asset Management and Gavyn Davies of Fulcrum Asset Management. Sushil, forget crunching the numbers and earning multiples for a second. I'd like you both to turn to political punditry for a minute. What, Sushil, in your view, is the chance of the US averting sliding over this $600 billion fiscal cliff of automatic spending cuts and tax rises in January?
I don't want to sound complacent, but I think the odds of getting some sort of deal to avert most of the fiscal tightening embedded in the cliff are quite high. And I think there are two reasons for that. First, no one wants to be blamed for the recession that would occur. And second, I think in August 2011, when we didn't get a deal, it was because the Republicans in Congress thought that they would be dealing with the Republican president now. And since that hasn't materialized, I think it improves the chances of a deal.
You want to put a number on that?
I think there's a better than a 50% chance that we get a deal either by year end or very early in January. And I say very early in January because if they don't get some sort of deal by the end of this year, then I think the equity market will respond very poorly. And I think that will then force them back to the negotiating table. Right. And I would then expect a deal before the president is inaugurated.
Now, you've touched on the market impact there. Let's take a look at the charts. Hopefully we should have the S&P 500, there it is, and the US 10-year Treasury, both doing different things, of course. I mean, there's any number of potential outcomes here, Gavyn. No deal, for example, could see the US tumble into recession. Equally, a grand bargain, as it were, could see years of growth sapping austerity. There's been some sort of reflection of that in the move, particularly in US Treasury yields. Are people rushing into those bonds in the belief that pessimism is the order of the day, or what do you think?
Yeah, I think they have been lately. I mean, since the presidential election, the bond market has rallied quite markedly. And I think it's pessimism about will they do a deal, and if they do, I agree with Sushil, they will, what sort of deal will it be? Because the content of the deal is still very unclear, I think. It could be a very small fiscal tightening next year, or almost none, or it still could be a 1 to 2 percentage point of GDP fiscal tightening. And lately, some economists have been thinking at the top end of that, nearer 2% than 1% in terms of fiscal tightening. So it's not just when do they walk out of the offices, waving triumphantly, but what actually is in the deal. And I think if they do anything near a 2% fiscal tightening, then bonds will rally further and equities will decline. I don't actually expect that, but that's what the markets are worrying about.
And Sushil, where do you see the S&P headed next year then on the back of that?
I agree with virtually everything Gavyn said. So, clearly it's going to depend to a significant extent on the precise nature of the deal. Having said that, if you sort of look forward, say, to the second half of next year, I think if you've removed this big impediment to growth, which is the degree of uncertainty engendered by not having clarity on the fiscal situation, then I think you could end up stimulating corporate investment. Corporate cash balances are, of course, unusually high. And the housing market is unambiguously recovering. If you then couple that with a second engine of growth, which is the corporate sector investing more, hiring more, then I think one could be surprised by how resilient the US economy turns out to be. And you could have a scenario where the S&P first dips because of the disappointment of the content of the deal, but then actually rallies later in the year as better growth materializes.